Okay, so I think there are two issues which I want us to discuss today. One is how to determine the optimal capital structure of the firm, and two, the concept of adjusted present value. How to determine the firm's optimal capital structure. I hope you guys have gone through my small document I shared on determination of the firm's optimal capital structure and the concept of adjusted present value. So those are the two issues which I'm interested in today. So those are the two issues which basically I want us to talk about. And because you already have the notes, I think our role is to simply to summarize the information you have on those two issues. There's a question I left, a very old question, June, I think December 2007. I did it deliberately so that we can discuss the optimal capital structure computation so that you guys can connect. Once we discuss the optimal capital structure computation, I think it will be very, very easy for us to connect that discussion to that question, MM4. But the issues which I brought in that are related to the optimal capital structure computation, I decided to leave it deliberately so that once we discuss how to determine the optimal capital structure, we can fall back to that question, and I think it will make sense. Some time back, when I was introducing this topic, I did indicate that when making capital structure decisions, the ultimate objective of making a capital structure decision is basically to determine the firm's optimal capital structure. The ultimate aim of making our capital structure decision is basically to determine what is referred to as the firm's optimal capital structure. And I said that an optimal capital structure is an optimal mix of the various elements of the firm's capital structure. When I talk about a capital structure, it's a mix of the various elements. Capital structure is a combination of equity, debenture capital, and preference share capital. That is capital structure. The ultimate aim of making a capital structure decision is basically to ensure that a firm adopt and maintain a capital structure which is optimal. What is this optimal capital structure? Is the optimal mix of equity and debt, the optimal combination of equity and debt, at which point the firm's value will be maximized and weighted average cost of capital minimized. That is the most important issue. That at the optimal capital structure, the firm value will be maximized and the weighted average cost of capital minimized. This means that firms will adopt an optimal capital structure, sometimes referred to as a target capital structure. Remember I said that an optimal capital structure is also referred to as a target capital structure, the optimal mix of equity and debt in the firm's capital structure, at which point the value of the firm shall be maximized and the overall cost of capital minimized. So please let's have that at the back of our mind. Kindly let's have that issue at the back of our mind, that the ultimate aim of having a capital structure that is optimal is to ensure that the firm's value will be maximized and also to ensure that weighted average cost of capital shall be minimized. Okay, that is very, very, and by the way, that is the criteria that we use to determine the optimal capital structure. That is the criteria. Looking at the point where the value of the firm is maximized, or looking at where the weighted average cost of capital is minimized. That is the basis of determining this optimal capital structure. Identifying the point where value of the firm is maximized, or looking at the point where the firm's weighted average cost of capital is minimized. Now, in this discussion, we make a fundamental assumption. We make a fundamental assumption that there are only two elements in the firm's capital structure. Please let that point be very, very clear. I know capital structure has many, many components, like ordinary share capital, reserves, debenture capital, preference share capital. But while we go through this discussion, we are making a fundamental assumption that there are only two items in the firm's capital structure, namely equity capital and debt capital. And if then that assumption holds, then at the optimal capital structure, we expect to identify the optimal equity proportion and the optimal debt proportion, establishing the optimal equity proportion on the optimal debt proportion, or establishing the optimal debt level. Kama hii swali niliwacha, ilikuwa inauliza hiyo swali, and I deliberately left it out for the time being. Sijui kama mliona hivyo. This question of December 2007, if you check number 2, the company's optimal debt finance, you see? If you go to number 3, the company's optimal debt finance, you see, it's connected to what I'm talking about. That at the optimal point, the company's value can be maximized and the overall cost of capital is minimized. In this illustration, the same illustration, if you noticed, I added a question 4. I added a question 4. This is the question I added. You see, using results obtained above, determine the optimal weighted average cost of, determine the firm's optimal capital structure proportions. So I felt if I went ahead and discussed this question last time, then I think it could not have made much sense before addressing the question of the optimal capital structure. Okay, so I think that is the issue, and you can establish the optimal level on the basis of looking at where the firm's value is maximized and the overall cost of capital is minimized. But before that, and by the way, when we bring in this issue of optimal capital structure computation, the other interesting thing is that the capital asset pricing model comes in. The capital asset pricing model comes in this discussion in establishing the cost of equity of a firm at various levels of debt. Now here, you can see 10% debt. You can find the cost of equity of a levered firm, 20% debt. You can find the cost of equity of a levered firm, 30% debt. You can determine the cost of equity of a levered firm using the capital asset pricing model. And also that model by Robert Hamada comes in estimating the beta coefficient of equity of a levered firm. The Hamada model that we talked about some time back comes in estimating what we call the beta coefficient of equity of a levered firm. Anytime the Hamada model comes in, CAPM goes hand in hand with CAPM. You estimate the beta coefficient of equity of a levered firm at each of these levels of debt, and then use the capital asset pricing model to estimate the cost of equity, and then proceed and work out the weighted average cost of capital. This question reads that the finance director of Babito Limited wishes to determine the company's optimal capital structure. The cost of debt varies according to the level of gearing of the company as follows. Is it November 2019? Is it true? Can you please confirm your past paper? Ni kweli? Hiyo swali ni ya November 2019. Question 2B, eh?
Yes, it's the one.
Okay, it says the finance director of Abito Limited wishes to determine the company's optimal capital structure. The cost of debt varies according to the level of gearing of the company as follows. Percentage of debt, 10% debt. Pre-tax cost of debt, 6.5. Notice the question is saying pre-tax. 20% debt, the pre-tax cost of debt, 7.1. 30% debt, 7.8. 40%, 8.5. 50%, 10. 60%, 12. 70%, 15. Notice pre-tax. Now, if the proportion of debt is 10%, then equity is 90%. Here you conclude. If proportion of debt is 20%, equity should be 80. If proportion of debt is 30%, equity is 70. That one you should be able to infer straight away. Additional information. 1, company's ungeared equity beta, 0.85. Ungeared, this is unlevered beta of equity, which is sometimes simply known as the asset beta. Risk-free rate of return, 6%. Market risk premium, 14. Now you need to be very, very careful. Market risk premium is the difference between expected return of a market portfolio and the risk-free rate. Corporation tax rate, 30%. Required. What is the firm's optimal weighted average cost of capital? And hence, determine the firm's optimal capital structure proportions. Firm's optimal capital structure proportions. Yeah, so we can answer 2 questions. Determine the firm's optimal weighted average cost of capital, the minimum. When you talk about optimal weighted average cost of capital, is the minimum. I don't know whether you use the word minimum or minimum. Okay, so you can see that that means we need to establish the weighted average cost of capital of a company at each of these levels of debt. When the proportion of debt is 10%, I've said equity 90%. When debt proportion is 20, equity 80%. When debt proportion is 30, equity 70%. And by the way, when I talk about debt proportion, you need to recall this is B divided by V. And when I talk about an equity proportion, S divided by V. Mnakumbuka hiyo? Sasa hii bila mtihani imekaribia, nafikiri lazima mkumbuke sana si ndio? I think you need to remember as much as possible. Okay. At the end of the day, we are expected to get the weighted average cost of capital, but cost of equity has been hidden, and we need to work out cost of equity using CAPM. Cost of equity of a levered firm using the capital asset price model. In the light of the information given, I think it is very, very, very clear, ladies and gentlemen, that we shall use the cost of equity. We shall use the capital asset price model to find the cost of equity. We're given here ungeared equity, ungeared, but this company is levered. So we bring in the Hamada model to find better coefficient of equity of a levered firm. BEL equal to BEU, 1 plus B over S, 1 minus T. The company is levered. What we have here in this question, in additional information number 1, is unlevered equity beta. And because it's possible to use the Hamada model, then now we have to work out the beta of equity of a levered firm, which is beta of equity of a levered firm, 1 plus B over S, 1 minus T. So asset beta is 0.85, 1 plus proportion of debt. Now, B ideally should be market value of debt divided by market value of equity. B is market value of debt, S is market value of equity. In the absence of those market values in shillings, then B can be taken as a proportion of debt and S the proportion of equity. B is market value of debt, S is market value of equity. In the absence of those values, like what we have in this question, we have no market value of debt here in shillings, and we have no market value of equity in shillings. Therefore, the alternative is the market value proportion of debt, in this case 10%, and the market value proportion of equity, in this case 90%. So, can you confirm? Asset beta is 0.85, 1 plus market value proportion of debt, 0.1, divided by market value proportion of equity, times 0.7. 1 minus T, 1 minus 30%, that is 0.7. Hiyo inawapatia ngapi? Hebu confirm tafadhali. Kwa namna hiyo takapo, ndio.
0.92.
0.92. That is the better coefficient of equity of a levered farm. So enter straight away to CAPEM, that level of debt. The cost of equity of a levered farm is risk-free rate plus beta of equity of a levered farm, expected return of the market portfolio minus risk-free rate. Risk-free rate is 6% plus beta of equity of a levered farm, 0.92. Expected return, it's an error here. There's an error in the question, isn't it? Expected return of a market portfolio minus risk-free rate is the market risk premium. The original question.
According to the question, it says the market return is 14%.
Oh, see your premium,
Mm.
So the expected return of the market portfolio, badilisha hapa Kwa nimesema wazimu yangu imetokea wapi? Hii asubuhi wazimu yangu inataka kutokeza hii asubuhi. Expected return of the market portfolio. Hiyo ni sawa. I think you'll sort out those problems. Nani huyo ameona haraka namna hii? Nani huyo ameona haraka namna hii? Kuongea jina. Umefanya kazi mzuri hivi. Huyo ameona haraka namna hii ni nani? Hataki kuongea. So I think that is okay, isn't it? So the expected return of the market portfolio 14 minus 6 is the answer 13.36. The cost of equity of a levered farm. Can you please confirm again?
Yes.
The cost of equity.
Yes, it is
13.36. Let's analyze that level of debt to the end. Let's establish the weighted average cost of capital of a levered farm at that level of debt. 10% debt, 90% equity. Tunaleta formula yetu sasa, Sawa. Weighted average cost of capital is cost of equity of a levered farm, S over VL plus KD, 1 minus T, B over VL. So cost of equity, hii ndio tumetumia CAPEM tukapata 13.36. Proportion of equity, S over V, is the market value proportion of equity, 90%, that is 0.9. Now, KD is the before tax cost of debt. Nafikiri mkienda kwa swali, ndio hii hapa juu. Naiona, at 10% debt, the before tax cost of debt is given here, 6.5. Sasa hiyo ndio tunaenda hapo, tunachukua before tax cost of debt, 6.5, 1 minus corporation tax rate, times the market value proportion of debt, 0.1. Is weighted average cost of capital 12.52? Company's weighted average cost actually is weighted average cost of capital of a levered farm. Really confirm the answer. I hope you guys are finding this discussion interesting. Is it interesting by any chance?
Yes.
Sasa hizi mkipata kwa mtihani mnararua tu. Mnamaliza haraka, nyamaza si ndio? Dimeka nera ya kuleta vitu kama hizi, mnaweka marks kwa mfuko haraka haraka. Is the answer 12.52? Please confirm. Mimi nataka kufanya the first 3. Hizo zingine you confirm the figures. Do you find 12.52?
0.48.
Huh?
12.48.
That is Gabriel.
Yes.
Your answer is not correct.
Main mepata 12.48.
It's 12.48.
Oh, nibadilisha hapo
Yeah.
Gabriel, you okay?
Yes, very okay.
Kitu hiyo bata na wewe ulinipeleka mpaka hospitali.
Amesikupata.
I was worried bwana. Umepata hii kitu?
Sikujapata.
I was wearing mask anyway, so I don't think I could have caused any problem to you. Okay, let's look at the other level of debt. 20% debt. The question gave you 20% proportion of debt. Equity is 80%. So the first thing, because we don't know the cost of equity, we have to use CAPM again to find the cost of equity of a levered farm. So you apply Amada model. So here I think I should have said using Amada model. Using the Amada model. Modeled by Robert Hamada. Using the Hamada model. Okay. So upper asset beta 0.85, 1 plus proportion of debt. Kama umepewa market value, unachukua hiyo. Kama market value say ni 20 million, unachukua 20 million of debt. Market value of equity ni 80 million, unachukua hiyo. Ini hiyo hatuna, so proportion of debt 0.2, proportion of equity 0.8, multiplied by 0.7. Is the answer 1? Sija kunywa chai. Waache maendelea kuconfirm na mimi nikunywa chai Ndiamuka nikaenda kupiga lap moja. Kurudi masaa imefika Haya, please confirm. Is the levered equity beta 1? If you see an error, please let me know, because you see I'm directly in my book that can correct it. Decided to use my book so that nikipata error na correct immediately. You guys are going to be my marketer for this book when I release it.
Answer is 1.
That is okay.
Yes.
When I release this book, mimi ndio mtani marketia.
0.
0 point. It's roughly 1.
Yes.
Okay, so that means the cost of equity will be 14. The cost of equity of a levered farm will be 14.
Yes.
Definitely. And therefore, the overall cost of capital, to the direct sasa, you see now it's the application of your section 3 background. So cost of equity, 14, market value, portion of equity, 80 plus before tax cost of debt, hiyo imepeana hapa juu. Ala, 7.1 ama 7? Is it 7.1? Before tax cost of debt. Kwa past paper inasema nini? Is it 7.1 or 7?
7.1.
Mimi nimework out kutumia gani? Naona wazimu zangu zingine hapa sasa nilitumia 7. Should be 7.1, eh? Please confirm the answer then. Can you confirm the answer? Weighted average cost of capital at that level of debt. Inakuwa ngapi? I think this must change, eh?
12.19.
So, oh, the answer has not changed.
Yeah.
Could you please move on and confirm at 30, 40, 50, 60, and 70? Okay, can you please confirm the levered equity beta at 30, 40, 50, back 70? Confirm the cost of equity, and please confirm the overall cost of capital. That one you're capable of doing very, very fast. Eh? Ama mmeona hiyo? Do you need to confirm now, or you can confirm later? No, namna gani? You confirm now.
You can confirm later.
You confirm now for me. Okay, fine. You can see how it goes. Eh? Now, once you have gone through mpaka huko mwisho, kienda mpaka huko mwisho, what is the question asking now? Go back to the question. What is the question asking? The firm's optimal weighted average cost of capital. Optimal is the minimum, and hence the firm's optimal capital structure proportion. Which is the minimum? By inspection? By inspection, which is the minimum? Could you give the one in red?
40% debt and 60% equity.
So optimal capital structure. Optimal weighted average cost of capital. The optimal weighted average cost of capital is 11.96. Ile ndogo, eh? And therefore, I think ingekuja kwanza. The optimal capital structure of the firm. The optimal capital structure of the firm is 40% debt, 60% equity. The optimal capital structure proportions. The optimal capital structure proportions of the firm is 40% debt and 50% equity. Hence, the optimal weighted average cost of capital is 11.96%. Minimum. Hiyo ni ngumu kweli kufanya namna hiyo. Ni ngumu kweli wenzangu. Let me go back to this question now. Kidogo, eh? Hii swali ni swali ya zamani. December 2007, question 1B. And it says, Dawanox Limited, an unlevered firm, generates an average earnings before interest and tax, 20 million per annum. Dawanox Limited, unlevered. You know, there are things that you need to take a lot of care. Dawanox Limited, unlevered firm generates on average earnings before interest and tax of 20 million per annum. Market value of the company as at that 1st October 2019, company's financial year end was 120 million. Market value of the company. Now that the company is unlevered, I have told you before that the market value of the firm is the market value of equity. If a company is unlevered, then the market value of the firm is equal to market value of equity. So in this case, 120 million is the market value of equity of the firm, and that is the value of the firm. Management of the company had considered the use of debt finance. You see again that will change status of the firm from unlevered to levered. They are considering the use of debt finance, so that can change the capital structure. And I provided the following additional information. One, estimate the present value of any future financial distress costs, 8 million. This one comes in MM4. Two, the probability of financial distress will increase with leverage according to the following schedule. I forgot to share this link to Kitengela. Wale wako available waingie. Nimesahau namna gani shwari. Nilisahau shwari. Please allow me to share this. Lakini sasa si wale wako, let me share this link to Kitengela class. Did I share? What? Because those who can be available wanaweza ingia class ya mchana. Anyway, no problem. We'll give them the recording. So the probability of financial distress will increase with leverage according to the following schedule. Value of debt, probability of financial distress, 25 million, no distress. 50 million, 0.0125. 75 million, 0.025. 100 million, 0.0625. 125 million, 0.125. 150 million, 0.3125, and so forth and so on. Additional information number 3. Tax rate 30%. Required company's cost of equity and weighted average cost of capital as at 31st October 2019. Sasa, your debt, 31st October 2019, it's very clear the company is unlevered. Yeah, the company is unlevered. And the market value of that company on that date is 120 million. So when the examiner tells you cost of equity and weighted average cost of capital, you can see they cannot be different. I think it's trying to test whether you appreciate that concept. But if a company is unlevered, the cost of equity is the weighted average cost of capital. So there's something the examiner is trying to test here. Ideally, for an unlevered firm, the cost of equity is the same as the weighted average cost of capital. And this is what I've worked out. The firm's cost of equity and the weighted average cost of capital. So I've confirmed that VU, recall that VU is equal to S, that's 120 million. Cost of equity is operating income. This is a levered and unlevered firm, so you don't have to worry with interest. 1 minus T divided by market value of equity times 100. And if we substitute, I think that should give us 20 million. The question gave us 20 million operating income. Yes, 20 million is operating income. No need to deduct interest because the company is unlevered. 1 minus T divided by the market value of equity. Cost of equity is 11.7. Is that correct? Ukienda kwa calculator zenu, does it give you 11.7?
Yes, yes.
And since the company is unlevered as on 31st October 2019, then weighted average cost of capital is equal to cost of equity, which is 11.7. Here, hakuna calculation. You simply infer. Ili tuko pamoja hapo, eh? Haya. Next. Number 2, the company's optimal level of debt finance using Modiglian and Miller with taxes model, excluding financial distress costs. Now, in this question, you can see that we're given financial distress costs. In this question, you have no personal tax rates on debt returns and no personal tax rates on stock returns. And we are asked to exclude financial distress costs. Then it goes without saying that we shall use MM2 with corporation tax model. Company's optimal level of debt using Modiglian and Miller with tax model, excluding financial distress costs in this question. Now, for us to be able to determine the optimal level of debt, we have to check the point where the value of the firm is maximized. At each of these levels of debt, we need to check the point where the firm's value is maximized. So this is what I'm doing, and I think I've already explained. The basis of determining the optimal debt level in this context, let me say, in this context, because we cannot generalize contexts. In this context is establishing the point where the value of the firm is maximized. Shall be establishing the point where the value of the firm is maximized. So that means we have to check value of the firm at 25 million debt, 50 million debt, at 75 million debt, even back at 200 million debt. We use a MEM2 model to find the value of a levered firm. And I told you yesterday that VL is VU plus BT. VU, we know. The value of a levered firm is 120 million. So at this level of debt, 25 times corporation tax rate. Does that give us 127.5 million?
Yes, it does.
Now, when you move to 50 million debt, value of unlevered firm is a constant plus 50, 0.3. I think that should give us 135 million. 75 million debt. The value of unlevered firm is 120 plus 75 times 0.3, I think 142.5. At 100 million debt, that is 120 plus 100 times 0.3, which is 150. Even mpaka chini. So we will determine the value of a levered firm at each of these levels of debt, and by inspection, where the value is maximized is 180 million. If we use a MEM2 with corporation taxes model, value of this firm is maximized at 180 million. Therefore, the optimal debt is the corresponding debt of 200 million. That is where value of the firm is maximized. Is that okay, ladies and gentlemen? So
Yes,
Yes.
okay.
that winds up
Yes,
number
understood.
2. That winds up number 2. Number 3, optimal level of debt finance using Modigliani and Miller with taxes model incorporating financial distress costs. Now, if you look at this question, we are not given personal tax rates in MM3. In the absence of personal tax rates in stock returns and the personal tax rate on debt returns, then you move from MM2 and remove financial distress costs. So we'll repeat the same question. Value of a levered firm is value of a levered firm plus BT. Kufika hapa ni MM2 less financial distress costs. Present value of financial distress costs. Now, we don't have personal tax rates. Otherwise, we could have gone to MM3 and then remove present value of financial distress costs. So, what's the probability of financial distress at 25 million debt? What is the probability of financial distress? 0. Probability of financial distress at 25 million debt is 0. So clearly, no financial distress cost will be incurred there. That's why I'm saying 0 times 80. 80 is given in the question. 80 is given in additional information about what? 1. Estimated present value of any future financial distress cost is 80 million. And if the probability of financial distress is 0, then 0 times that. That means financial distress costs at 25 million debt is 0. Sasa hapa kuna financial distress, your value does not change. Let's check at 50 million debt. Hebu angalia at 50 million debt, what's happening? So the value of unlevered farm is 150 million plus the amount of debt, 50 times 0.3 minus present value of financial distress costs. Now, at 50 million debt, we're given the probability of financial distress. At 50 million debt, probability of financial distress is what? 0.0125? This is a chance of financial distress. Multiply by those financial distress costs of 8 million, so that we establish estimated value of financial distress costs. So all these figures are in millions. Ukichukua 0.0125 times 8 million, how much will be the estimated value of financial distress costs?
1
million.
Ukitoa kwa hiyo, does it come to 134 million?
Yes.
Haya, ukienda 75, if debt is 75 million, that is 120 plus amount of debt times 0.3 minus present value of financial distress costs. The probability of financial distress at 75 million ngapi? What is the probability of financial distress? At 75 million debt, probability is 0.025. So times 8 million to know the actual estimated value of financial distress cost. Ukichukua 0.05 times 80, remove it from the answer there. Do you find 140.5?
Yes, 140.5.
Hiyo inaweza endelea mpaka chini. Would you please confirm for me? Those ones you are capable of confirming quickly. 100 million, 125, 150, and 200. Are the answers correct? Value of a levered farm? Can I assume the figures are correct?
Yes, confirmed. They are correct.
So which is the optimal debt level now? Where is the value maximized? Where is the value of the farm maximized? That is the one in red,
Yes.
147.5 million. Is that Millicent who has confirmed? Or Marceline? Marceline. That sounds like Marceline. Is it true? Is it Marceline who has confirmed or who?
I'm the one who has confirmed.
Marceline.
Confirmed.
It is Marceline.
No, not Mark.
Your name
No.
is?
Sharon.
Sharon.
Yes.
So, hakuna error hapa, Sharon.
No, I've confirmed all the figures.
So 147.5 million is the optimal.
Yes.
The optimal.
Yes.
This is where the value is maximized.
Yes.
So what is the optimal debt level? 125 million now. So the question was asking for the optimal debt level. So now that value is maximized at 147.5, the optimal debt level is 125 million. Hiyo swali inafaa ifike hapo, but I went further to add information so that we can clarify some issues. Hiyo number 4 haiko kwa past paper, mimi ndio nimeleta. It's a continuation. Suppose the pre-tax cost of debt at each debt level are given as follows. So value of debt is 25, 50, 75, 100, 125, and so forth. Pre-tax cost of debt, assuming those are the pre-tax cost of debt. Using the results obtained in 3 above. We know the value of a levered farm in 3 above. Using a MEM4 model. Using the results obtained in 3 above, determine optimal weighted average cost of capital. 2, the firm's optimal capital structure proportions. Comment on your results in B above. Why am I interested in B? Oh, yeah. Comment on your results on B above. Are you guys seeing where my mind is headed to? The optimal weighted average cost of capital using results obtained in part 3 above. Which are the results we have in part 3? Is the value of a levered firm at each of those levels of debt. Now, if you check at 25 million debt, the market value of a levered firm is 127.5. So what will be the market value of equity? It's the difference between 127.5 minus 25. Equity is residual. Now that the market value of a levered firm here is 127.5, deduct market value of debt to find market value of equity, and then establish the cost of equity. If the market value of a levered firm is 134 million minus 50 million, debt, to find the market value of equity, then determine the cost of equity. So we are required to establish the optimal weighted average cost of capital of the firm. Debt, we know 25, 50, 75, 100, and so forth. Value of a levered firm, ndio hizo. Market value of equity is residual. So 127 minus 25, you know, 102.5. 134 minus 50, market value of equity is 84. Naendelea hivyo. Unfortunately, we have negative market values of equity here. So nafikiria vile nitafanya, because I don't think realistically we can have a negative market value of equity. These figures I picked them random, but I think in my final document, I have to find a way to deal with this problem here. So cost of equity, now we say cost of equity, ideally, this is a cost of equity of a levered firm. Hiyo ni cost of equity of a levered firm. So we go to our formula. Hapa hatuwezi tumia KPM sasa. Hatuwezi tumia KPM. Operating profit minus interest. Now, we are given corporation tax rate. So 1 minus T divided by the market value of equity times 100. Operating income is 20 million minus interest at 25% debt. How much interest is payable? 25% debt. How much interest is payable? 7% of 25. Ni ngapi hiyo? 7% of 25. Ni ngapi?
1.75.
Ndio hiyo nimetoa hapa. Sawa sawa. So operating income minus interest. 1.75. 1 minus tax rate. Divided by market value of equity, the residual value.
1.75.
Sasa hiyo 1.75 unatoa kutoka operating income. So 20 minus 1.75 times 0.7 divided by the market value of equity, which is the residual. Market value of equity in residual. 102.5 times 100. Do you find the cost of equity of 12.46?
Yes, 12.46.
Hiyo ndio cost of equity. Haya. Hebu tuendelee mpaka mwisho kwanza on that. Is it possible to find the weighted average cost of capital of a levered firm at that level of debt? I think we should. We need to be a bit careful here. Okay, so the weighted average cost of capital is cost of equity of a levered firm. cost of equity of a levered farm times market value weight of equity plus KD 1 minus T B divided by V. Do we know the proportion? Now, just a minute here. Here you have to be very, very careful. If debt is 25 million and the total value of the farm is 127.5, what's the proportion of debt? B over V. Ngapi? And proportion of equity is 102.5 divided by 127.5. Can you confirm? 102.5 divided by 127.5 is equity proportion 0.8?
Yes, 0.8.
Yes.
If that proportion is
0.8.
25 divided by 127.5, is that proportion 0.2?
Yes, 0.2.
So is it possible to know the weighted average cost of capital? We should. Cost of equity, you have got 12.46, eh? See, ndio umetumia hapo, not CAPEM, that formula. So cost of equity is 12.46 times 0.8 plus before tax cost of debt. Hiyo nilikuwa nimepeana hapa, hii swali. I assumed 7 before tax cost of debt, 7%. So you pick that, 7, 1 minus 0.3 times the market value weight of debt. Is the overall cost of capital 10.95? Could that be the overall weighted average cost of capital of the farm? Please confirm again.
Yes, it's 10.948 or 10.95.
Okay. Nataka kufanya tu the first two. First two, eh? Ukishaona zingine mtafuatilia namna hiyo. We break kidogo and then we come back for the adjusted present value concept, talk about it and we finish those concepts. Upatie time kunywa chai kwanza, si ndio? For those of you who want to share notes with your boyfriend, mnaweza share haraka, ndio tuendelee part 2, eh? Haya. Unataka kupatia watoto chakula, pia unaweza pata time ya kupatia watoto chakula, eh? So debt, if debt is 50 million, value of a levered farm from part 3, hiyo tumepata at that level 134 million. So equity is residual, 134 minus 850, which is 84. Is that so? Equity is residual. So your column
Yes.
has
Yes.
cost of equity. Sasa tunaenda kwa formula. Operating income is 20 million minus interest. What's the coupon rate I've used? At 50 million debt, I've assumed a pre-tax cost of debt of what? 8, eh? 8 times 50 million. How much interest is payable?
4
8%
million.
times 50 million.
4 million.
Sasa si ndio hiyo naona nimetoa hapo, eh? The working here does not look nice. I have to find a way to make it look nice, eh? Sijafurahia sana na hii working hapa. So 20 minus 4. Then, because we have corporation tax rates, 70% of that, 1 minus tax rate divided by the market value of equity, residual of 84 times 100. Your cost of equity is 13.33.
Yes.
Sasa tukienda kwa overall cost of capital, computation, proportion of equity here is 84 divided by 134. S over V, the equity proportion, is it 0.63? 84 divided by 134, 0.63?
Yeah, 0.63.
50 divided by 134, 0.37? That proportion?
Yes.
Is very nice. Yuni Sharon tena. Sharon, you seem to be active today, eh?
Yes.
Nice. Okay. Overall cost of capital. Cost of equity tumepata 13.33. Hii ndio tumepata hapa juu. Times proportion of equity 0.63 plus pre-tax cost of debt. Hiyo tumepeana 8 times 0.7 times that. Does it give you 10.47? The overall cost of capital. The overall cost of capital. 10.47, eh?
I'm getting 10.37, but let me repeat it again.
Sasa hii class kuna calculator moja tu, eh? Je, tuko na calculator moja tu, eh?
Yes, it's 10.47. I had put 0.62 instead.
Sasa hizo zingine zote naweza endelea namna hiyo mpaka chini, eh? Now you can confirm later which is the optimal weighted average cost of capital by inspection. Assuming my figures are correct, which is the minimum?
9.5.
So what is the optimal capital structure then? Proportions?
0.1.
Equity 15, debt 85.
Yeah.
See, my conclusion is not very good. Question I have to rethink. But you see, it's not making much sense, eh?
Yeah, it's not.
So picking figures at random. Okay. That's why I'm commenting on the figures. Oh, that's the reason why I said comment on the results. Oh, I was trying to cover myself, eh? Comment on the results in the B above. I was trying to cover myself, eh? Because the figures are not realistic. Eh? The analysis reveals that the optimal proportion of equity 15%, whereas optimal proportion of debt, it appears that the owners control a very small proportion of the farm, eh? Very small proportion of the farm when compared to the control of the non-owners. Even though the analysis reveals so, in reality, it's not practical. Oh, I think it is clear. I don't have to waste my time. See, I've covered myself. The analysis is not practical. We expect the equity holders to have a greater control of the farm. Similarly, it's evident that the farm is highly geared, which exposes the farm to financial risks, which can expose the farm, which can expose the farm to financial distress, which can expose the farm to financial distress, and hence expose a farm to financial risks. For these reasons, our findings in B above seem not to be realistic in practice. Eh?
Yeah, you forgot.
Forgot to? I forgot to do what, madam? Now, did this concept, was it tested last sitting? What I'm talking about here? Did I see something like that last sitting? Hii kitu hii inaongea hapa sahi. Did it appear last sitting?
Yes, November 2020, question 5.
Ngoja kidogo ni hapa so that. Inasoma namna gani, madam? Hebu tusome, tusikie. November
2020, question 5B.
Question 5 B. Hebu ngoja kidogo tafadhali kabla tuangalie hiyo. I'm not attempting, of course. It is an exercise you'll do. Niwacha niweke hii hapa. It can be an exercise to students. Eh? November 2020.
Yes, question 5B.
Ni kama hii kabisa. Sasa hiyo mnaweza jaribu. Si hiyo mtajaribu wakati mko na free time, eh? Can you please, madam, read on the required by section only? What does it say?
The current cost of equity and weighted average cost of capital. Then number two, the firm's optimal level of debt using the pure Modigliani and Miller with corporation tax model. And number three, the firm's optimal weighted average cost of capital and hence its optimal capital structure proportions.
Okay, I want to request that we break and come back at 10:30 for the concept of adjusted present value. You saw from my plan, concept of APV. We'll embark on it at 10:30. So just break, take your tea, and let's come back at 10:30.
Okay.